one second. Now this is going to be a brief session where we'll just introduce the concept, and obviously with time we're going to be doing a bit more in terms of the work needed to actually make the whole thing happen. Right, so hope everyone can hear me. Audio is really good. Yeah, let's enjoy it. So if we look at something, we're going to be using one example for breakout, sort of like for our introduction. And the one example that we are going to be looking at is the Australian dollar, US dollar. There's no particular reason why we're using this. However, it does move sort of like almost like every other market. So we're just going to be taking it in that side. Now we're going to be using largely though the 4-hour time frame, because I mean, if you're looking at breakouts too small of a time frame, can lead to a lot of frequent setups and frequent trading, which is not necessarily the answer to a high win ratio or good risk reward ratio. So you want to keep trades minimal, right? Avoid over trading and just focus on the good quality trade setups, right? So what constitutes a false breakout? Now, a lot of people, traders rather, let me just say traders, right? A lot of traders will go through the notion or the sort of like when markets are going in one particular direction, right? They will feel like the market is about to turn, right? I think it's more of a natural inclination that the price has risen too high and therefore should reverse. And that beats a lot of people up because, I mean, the market has no flow and the market has no ceiling. Therefore, whatever may happen within the market, right, whatever may happen eventually within the market will be dependent upon the participants. So if the people are still willing to buy the USDJPY where it is right now, then it means that it will continue to rise, right? So if there are players who are willing to short the USDJPY where it is, I mean, the market will continue to go down, right? So it doesn't have a floor, it doesn't have a ceiling, therefore there is no such thing as overbought or oversold, technically, right? Because if there's anyone willing to still buy a market, then it's going to still continue to go up. So with that notion in mind, what you will find a lot of times is that people will have this natural inclination to short into markets that are really not ready to be shorted yet, and go long in markets that aren't really ready to do so just as yet. Okay, so let's take this example of the Australian dollar, US dollar. Okay, so this Aussie USD, for example, if we're looking at it on the 4-hour time frame, okay. Now, if you're looking at this market, what we like to see is a breakout. It doesn't really matter where the breakout came from. It could be the previous day's high, previous day's low, previous months or previous weeks low, or any sort of like previous setup or swing point. As long as you have that and you have a market or you have some significant previous action surrounding that particular market, then you will have a really good sort of sense that the market will be going in one particular direction. So if, for example, we have this swing low, let's use this swing low as an example, right? So currently, this is the same. Okay, so this is 68.30, right? So 68.30 was a previous support structure, boom, right? Market was broken and tested as resistance just a tad bit, and then you can see, right, I don't think I did mute everyone. Hopefully it should be fine now. Okay. And now we have this pin right above that 68.30 zone. Okay, right, so right at 68.30, we have the market SPY just above it. Right, you see that? And that is an area where we had previous market action. So those are the types of areas that we'd like to isolate as support structures and resistance structures, and therefore the breakouts are much more significant and are much more important than just looking at any swing high or just a recent swing high or recent swing low. Okay, so it needs to have previous market sort of like action within it, and therefore you might get a really decent entry. Now we spoke about, I think it was Australian dollar, US dollar, saying we're looking to go short if we have a really good breakout to the downside. Okay. Now, as you can see, the only significant level, so we basically highlighted these two levels, right? So this 68.30, right, which the market obviously you can see now rejected off it, and that's 69.07, which was the area that we were looking to really go short in, right? So if the market comes up to that 69.07 level, and because you can see it's a previous swing low area, right, and it's closer to a round number than 68.30. So there's a few things that obviously we're gonna put together later on, but for now, a breakout, a true breakout, will have the market closing above, let's say, a previous week's high, let's say here, for example, yeah, and then retest. So this is the previous week's high. This is a 4-hour time frame, and the market breaks above, and then comes back in to retest that area over here. Right, simple rejection candle. Boom, the market gives us an entry on the upside. Okay, now there's some other things that you can add to the mix to hopefully give you a much better chance or probability rather of the trade working out. We'll work on getting those tools available for you guys, but for now, just focus on the actual price action itself, because this is essentially how the market will move. Right? You have the market going, pushing to the upside, and there will be buyers right above this level over here. Okay, so right above the previous week's high, there will be buyers, right, catching the breakout on the upside, and the market will have a bit of a retracement due to the fact that there's some selling, there's a bit of a sell-off, okay, offloading of positions, and smart money usually comes back into the market to buy at a much cheaper price. It might not be a significant drop. It might be 25 pips, it might be 40 pips, it might be 50 pip drop. However, you will usually have this sort of like pull back into the zone, and the market will retest that swing high and then sort of like disappear. Right? So once you get a really good sort of like rejection candle that gives us confirmation that the market is ready to move, then we can take the trade. Because if you're just going to take the breakout just as is above that 68.90 level, then you're going to be looking at a really good, really wide stop loss. All right, so your stop loss will definitely go somewhere around here, and you're much more in danger of getting stopped out. Now, there is a significant danger, of course, as well, of the market just breaking above the swing high and not turning back and not looking back. Okay, but like I always say, you'd rather be safe than sorry. So rather take a much safer entry by waiting for the market to pull back into the zone that you'd like it to come back into, and then continuing on the move to the upside. All right. So what I'm talking about is this. Okay, so let me just find a really decent example. Okay, this is 4-hour. Okay, it's a 4-hour time frame. Let's just use a daily. Let's remove this. Okay, let's go to here. I'm hoping everyone can hear me. Okay, I'm hoping everyone can. actually hear me? Right, so let's just use this as an example, right? I know it's a bit difficult to actually see, but there was a swing low, right? Previous market structure that we have here, the market pulled away from that level and just broke with a very aggressive candle to the downside and came in, right? If you drop down to the smaller time frames, you'll see that it formed some sort of a push away from that level, right? Break away and then pull back, right? And then the market continued to move to the downside. Now, in every single instant, you're going to find these breakout areas, right? So we have the swing low here as well. Boom. The market formed a swing low here and then broke it with an aggressive candle, pulled back in and then retested. Then retested that area and then shifted to the downside again, right? So the continuation move was to the downside and therefore the momentum obviously was to the downside. We'll be looking at short opportunities in that particular instance. Okay. Trust you guys are still with me. Okay, and as we can see, we had this swing low as well. Market came, boom, rejected again, swing to the downside, right? And you had a bit of a swing to the upside here. However, the market didn't come in and reject the way we'd actually wanted to because it didn't quite reach that level. And until we get a tap in back at that level, even though your pending orders are probably going to be about 5 to 10 pips before that actual area, but you know certainly that you'd rather obviously miss an opportunity than to have to be in a losing trade simply because you rushed into the position way too early. Okay. All right. So that's essentially what we'd like to see. And obviously this is the most recent one. We have the swing high over here, the 68.27 level, 29 rather, and the market just broke above that level, boom, pushed up, and now you can see it tapped right back into that zone and is making those higher, okay, that advance to the upside, okay? Because we haven't broken any significant level just as yet. We'll see the momentum shift if we start seeing the market break above these swing highs here, right? So all of these swing highs, the market starts breaking all of these, then we know we are in for a treat, basically, okay? All right, you guys are good. Okay. All right. So if you're looking at most of these markets, we have similarly, so like the same type of setup. We have these swing highs that were established, and then the market rejected. Okay, so the market rejected. This is actually a previous level as well. The market rejected there and came in, broke above that high, boom, and came back into that zone. So it came back into that swing high at 23.85. I certainly would have probably missed this one simply because of the fact that obviously it didn't come into that level as well. Okay, and my long-term bias on the GBP USD obviously is still short, right? But like I did mention, guys, we have this swing low, which occurred somewhere like 3 weeks ago, swing low over here at 120. which really just gives me the impression that we could be in for a bit of an upward move. Right? Although I'm not going to change my bias, obviously, just as yet to the upside. However, there is a possibility that the market could push higher. Right? So when looking essentially for a breakout, it's nice to have a full body candle above it. However, the safest entry is always the retest on that swing high or that swing low area. Okay. You're gonna have instances where you have this swing high point. Okay, so let's just highlight this one. This one, boom, boom, the market broke above and came in textbook setup, booms. Right. This is basically a textbook setup. It looks really good on paper, but obviously the one thing that would have held us back from this is you can see just by the moving average that the trend is down, right? So the trend is actually down, and it wouldn't have made sense to really go long around this area, right? So you want to only take a breakout in line with the major trend. So if the major trend is going down, then you're looking at shorting opportunities. If the major trend is going up, then you're looking at buying opportunities. So if you want to trade reversal, if you want to trade reverse to the overall trend direction, it's going to be very difficult for you to take breakouts, because essentially false breakouts are what usually occur in markets that go into a range. Because after a really aggressive push, the market will have sort of like some time. So someone like, let's say you jump from the third story or the fourth story of your building, right? It's very unlikely that you're just going to stand up right now and start running or just continue with your day, right? You might lie down for a few moments. It might be a few minutes, might be a few hours, depending on how slackish let's say, ambulance services are around. But you're going to sit yourself down, take a breath or two, which is usually what happens within the market. So after an extremely aggressive move, either to the upside or the downside, the market will sort of like take a moment to breathe. And that's when the choppiness and sideways movement usually comes in, right? So when the market is moving sideways, there is a more prevalent of false breakouts, meaning the market breaks above or below in this instance, right? So if you're looking at this 120 level, below, okay, a pretty significant support level, right? So this is a pretty significant support level in that it dates back, I think, to 2016, yes, and the market closed below this, right? So now that would be reason enough for a lot of institutions and retail traders to go shorter on this level. However, the safest entry, if you're going to be trading the breakout, is to let the market work its way back up, get a retest of this 120 level, and then rejection candle gives us the entry to the downside. Okay. All right. Okay, you guys are good. Okay. And so if everyone is good, I will end off today's session. Like I said, today is just sort of like that introduction to what we're going to be doing for the next couple of weeks. So send me a text message if you guys have any questions, right? And I will upload this recording and then just send through the link in the group. So if you missed the first part of it, then you'll be able to replay it and sort of like take notes like wherever you need to. All right, so hope you guys have a fantastic evening. Enjoy the rest of your evening, and I'll see the beginners tomorrow at 7 p.m. Cheers.